Picture this, somewhere in Beijing, in a beige government office that probably smells like jasmine tea and silent power moves. Someone clicked a button. Not a dramatic red button, just a button. And $53 billion in US Treasury bonds vanished from China's portfolio. By June, another wave. By the time you're watching this, China has quietly unloaded over $600 billion in American debt since 2022. Now, if you're thinking, okay, countries sell bonds all the time, why should I care? For 2 decades, they were the creditor, the money printer's best customer. And now, they're walking toward the exit. The question isn't whether they're leaving. They already are. The question is what happens when the music stops. Let's rewind to understand how we got here, because this story doesn't start with China dumping bonds. In the early 2000s, China had a problem most countries would kill for: too much money. Every iPhone, every toy, every cheap gadget shipped to Walmart came back as US dollars flooding into Chinese banks. So, what do you do when you have $1 trillion problem? You buy the safest asset on planet Earth, US Treasury bonds. It felt political. It felt like leverage. American politicians would go on cable news and wring their hands about how China owns us. Here's the thing about being a creditor: you need your debtor to survive. China wasn't holding a gun to America's head. They were holding a stake in America's survival. It was the financial equivalent of a murder-suicide pact. Before we get to the dumping, you need to understand what China actually bought. You give them $1,000 today. They promise to pay you back with interest over 10, 20, maybe 30 years. For decades, this was the deal. China sells us stuff, we pay them in dollars. They lend those dollars back to us by buying our bonds. We use that borrowed money to buy more of their stuff. A perfect circle. Economists called it chimerica, one giant economic organism pretending to be 2 countries. But here's what most people miss. China didn't buy US debt because they trusted us. They bought it because they had no choice. When you are running a $300 billion trade surplus, those dollars have to go somewhere. And the Treasury market is the only pool deep enough to absorb that kind of cash without causing chaos. The alternatives: Eurobonds, smaller market, shakier politics. Gold can buy $100 billion without moving the price. Chinese domestic bonds that would strengthen their currency and kill their export edge. So they kept buying treasuries, not out of love, out of math. But here's where it gets interesting. That math is changing. The sell-off didn't happen overnight. It was slow, methodical. 2022, China's Treasury holdings dropped below $1 trillion for the first time in over a decade. 2023, they shed another $100 billion. 2024, the bleeding continues. Month after month, billions disappearing from the books. Now, China's holdings sit around $760 billion. Still massive, still the second largest foreign holder after Japan. So, what changed? 3 things happened almost simultaneously, and together they broke the old logic. Their export dominance is cooling. Not collapsing, but cooling. Second, the relationship soured. You can't weaponize tariffs, ban TikTok, restrict chip sales, and sail aircraft carriers through the Taiwan Strait without consequences. China started seeing U.S. treasuries less as safe assets and more as assets the U.S. could freeze if things get spicy. Third, and this is the one nobody talks about, China's desperate for dollars at home. Their real estate market is imploding. Developers are defaulting. Local governments are drowning in debt. The yuan is under pressure. They need liquidity, and U.S. treasuries are the most liquid asset on earth. They're selling because they need the money and they don't trust us anymore. When China was buying $100 billion in treasuries a year, that was $100 billion in demand, propping up bond prices and keeping U.S. interest rates low. Low rates meant cheap mortgages, cheap car loans, cheap everything. But demand works both ways. More supply, same demand, prices drop. When bond prices drop, yields rise. When yields rise, interest rates rise. Your credit card gets more expensive. The government's debt gets more expensive. Let's put a number on it. The US government is sitting on $36 trillion in debt. Every 1% increase in interest rates adds roughly $360 billion to annual borrowing costs. That's more than we spend on veterans' benefits. That's real money. And here's the kicker. We're still borrowing more every single year. The deficit for 2024 is projected north of $1.5 trillion. That's new debt. We need someone to buy. For years, China was that someone. Now they're not. So, who fills the gap? American investors, pension funds, banks. They're picking up some slack. The Federal Reserve occasionally steps in. But here's the truth. There's no one beer big enough to replace China without consequences. The market has to adjust, and adjustment means higher rates, which means slower growth, which means everyone feels it. The machine doesn't break, it just gets more expensive to run. Now let's pump the brakes on the apocalypse talk, because the internet is full of people screaming that China dumping treasuries will crash the dollar and American dominance and usher in some new world order where we're all trading in yuan and Bitcoin. That's not happening. At least not the way they think. The dollar is still king. Roughly 60% of global foreign exchange reserves are in dollars. Most commodities, including oil, are priced in dollars. The entire global banking system runs on dollars. China can sell every treasury bond they own, and the dollar would still be the world's reserve currency tomorrow morning. Why? Because there's no alternative. The yuan, China controls it too tightly. The euro. It's 20 countries pretending to be one economy. Gold. You can't pay for a container ship with gold bars. So no, this isn't the end of American financial hegemony. But it is erosion. Slow, steady, irreversible erosion. China isn't trying to destroy the system. They're trying to build a parallel one. Digital yuan, BRICS currency talks, bilateral trade deals that skip the dollar entirely. None of this replaces the dollar. But it chips away at it, death by 1,000 cuts. And here's the irony. The more we weaponize the dollar, freezing assets, imposing sanctions, shutting countries out of SWIFT, the faster other countries look for exits. We're not being dethroned, we're evicting our own tenants. Zoom out for a second and look at what's really happening here. For 80 years, the global economy ran on a simple deal. America provides security and liquidity. Everyone else plays by our rules. We print the money, we set the rates, we write the sanctions list. And in exchange, the world buys our debt and props up our lifestyle. It worked because everyone needed us more than we needed them. But that math only works if people trust the system, and trust is eroding. China's watching Russia get cut off from SWIFT and thinking, that could be us. Saudi Arabia's watching us lecture them on human rights while begging them to pump more oil. Europe's watching us subsidize our own industries while preaching free trade. The Treasury sell-off isn't just about interest rates, it's about confidence. It's a vote of no confidence in the idea that America will always be the safe bet. And here's what keeps me up at night. We responding to this loss of trust by doubling down on the tactics that caused it. More tariffs, more sanctions. More you're either with us or against us. We're acting like the empire we were in 1945, not the empire we are in 2026. So, where does this end? Honestly, nobody knows. Maybe China stops selling once they've stabilized their domestic mess. Maybe they keep going, slowly diversifying into gold, euros, and whatever BRICS dreams up next. Maybe other countries follow their lead. Maybe they don't. But here's what we do know. The era of China as America's piggy bank is over. The feedback loop that kept U.S. interest rates artificially low for 2 decades is breaking. And the global financial system that emerged from World War II is quietly, slowly reshuffling. There won't be a crash. There won't be a headline that says dollar dies. It'll just get harder and more expensive to borrow. Growth will slow, competitors will gain ground. And one day, we'll look back and realize the exodus didn't begin with $600 billion. It began the moment we stopped asking why they were buying in the first place. Thanks for watching. If you found this breakdown valuable, hit that like button and subscribe for more deep dives into the forces shaping our world. See you in the next video.